Hey guys, happy Wednesday. In this one, I'm going to run you over the dollar yen. The reason why we're going to do that is because there's plenty to look at, plenty to comment on, and plenty to learn as always. If you do enjoy this, go in the description, the comments, get started with myself, and we can trade in a great way every day. So, as you can see, if I pop this on the monthly, let's kick it off over there as we always do. I called this short. Many of you will know that because people said this is never going to fall. And of course it did. Now, it does baffle me sometimes when people look at high prices and think about buying them. Okay, no one does it outside of trading in the real world. But sometimes they come onto a computer, some sort of screen, and they think, you know what? This price is coming up and up and up and up. I'm going to keep buying it and buying it as if it's never going to fall. And people say, well, you know, the fundamentals of this, that, and the other, X, Y, and Z, the fundamentals of this, the news is saying this and that, and the market keeps going up and up and up and up in line with that news, and then suddenly the news changes, okay? And the sellers move in. So up here is where you see the news swap. Now, the longer this moves up, is simply just pending that news change, because ultimately the news is going to bring that down. Okay, sellers are going to see this at an historic price action level, and they're going to use that for a technical basis, and then the weight of that getting slammed down comes from a massive change in the market mood to the downside. That's exactly what happened, okay, as the yen gained value and the dollar lost value. And then you come down an enormous way. So you might have been short 150 area. You should be well out of this, guys, okay? If you're holding on to this, you're doing exactly what I was just saying. If you were buying and buying and buying and buying, okay, buying highs, if you're not selling this now, okay, and what I mean by selling it is selling out of your position, okay, if you're effectively getting long, right, then you're going to be on the right side. Okay, because to buy this, technically you don't need to get with an actual long position. If you liquidate a short, you're saying the market's long. If you don't liquidate a short, you're saying it's still a sell. Now, given the market's already come down so far, wouldn't you think it's likely that news is going to change again and the market's going to rebound, or a technical level's going to get hit and the market's going to rebound? Okay? So that's why I would be out of these shorts, because you're seeing exactly the same thing, guys. It didn't happen very long ago. The market comes up and up and up, and you're waiting for there to be a reason for it to fall. Okay? And eventually you get that reason. The dollar loses strength, and the market comes down. And now you're looking for a new reason. Okay? Looking for a new reason for this to change. Now, I would be out now, okay, and I would think we may trickle to your 1267 area, 127 roughly. Okay, that's ideal for risk-averse longs. So because of that massive down move, you can look to scale in there, okay, start to move into the long side of the market, because you've got a much better price and you're trading a pullback. It's going to come to your 20 MA. So within this move up, you're going to have a move down, and that rebound gets more and more likely as the price comes down. And it's the same on the way up. The further this goes up, the chance of a massive smackdown fall increases naturally. Okay, that's just how things work. And that's just because the probabilities change. If you go a long, long time without any massive market sentiment swap, okay, then eventually that's going to happen, and when it does, it's going to be ferocious, because it's likely to be a big change from what was going on before. And that's exactly what you saw. You had this continuous up movement, and then you get that massive change in market sentiment, which drags the market down. And then you're left with this. And your job becomes to look back to historic levels for where you want to exit, and then where you want to look to the long side. Because it's all well and good trading it short, but you need to know what you're doing to the long side. Now, if you had any previous longs you took and you're in my trading academy and you're using hedging methods to survive any massive swing without losing your money, then you would be out of all these previous positions you had and you would be in gains. Okay, and that is the point. We can survive any fall as long as we're trading the right size compared to our capital at any time. You need to be able to sustain these moves as a trader. And also that's why it doesn't help following signals, because you would have had traders who told you to short. But when? Okay? If they told you to short up here, they'll claim they did fine because the market's now lower. But it's moved up before that, and they give you stop loss orders. And that's why it doesn't work out, because your stop loss is going to get hit before the market falls. When you look at signals, they don't factor that in. The market might get where they want eventually, but if you trade with a stop, it's likely you're going to get killed on that beforehand. So if you trade mega small, okay, you won't have that problem because you're not going to run enough risk if your size is much smaller. But to round up, guys, the point of today's video is this. The longer the market moves up, the more vicious the move is going to be down, the higher the probability comes. So there's no good buying after 40% of a move up. Okay, you've missed it, you're late. And there's no good saying, okay, well, it's a bull market and it's going to go up forever, because it's never going to happen like that. The market will never go up forever and ever and ever and ever and ever and ever without pulling back in some degree. It has to come down at some point. Okay, that is why you get oscillations. If you zoom out in any market, that's what gives you oscillations. Good, bad, good, bad, good, bad sentiment. Constantly a mixture in the pot of sentiment and key technical levels where orders are going to go in. And it's your job to trade in between that. It's your job to identify that, because once you do that, you're obviously going to make more money. So always remember, eventually the market mood is going to swap. Something's going to happen in the world, something financial or something that's not expected but still financial. And it's going to affect all asset classes. And the ones that have already had such a move up are going to have the hardest moves down most of the time. So it's no good putting yourself out there and then getting burned. Okay, and lots of people will have found that unless they traded the right way. So don't buy the highs. Okay, don't sell the lows. This is not a time to be shorting. You want to be out of that short you had. Kill it for gains. Okay, no matter how low you think it's going to go, take it off. And you can start to scale into the long side, because again, you've got months down, you've got a couple of months of down movement. That is going to end in a move to the upside eventually, as I say. So thanks for watching that, guys. I hope that really helps. As always, we like to break things down in the simplest form possible. Remember, simplicity is beautiful. Okay, it will change your trading. It makes things so much easier to understand if you just break things down from a simple perspective. So I hope that helps, guys. If you want to get on board with myself, go under the video. I've got so many different things there, and see you in the next one.